everyone, this is DeLorenzo from United Asset Strategies. I'll be joined today by Thomas Healy, our Director of Client Portfolio Analysis, and Matt DeLorenzo, our Chief Investment Officer. As we've been doing, we'll take a look back at 2020, we'll look at where we are, where we think we're going. And if I had my wishes, we wouldn't really talk a lot about 2020. There's a lot of hardships that a lot of us faced, and before we get started, I'd like to say that if you've lost a loved one or suffered from the illness yourself or still going through a difficult financial time, hang in there. We've got limitless possibilities for 2021. So the stock market, though, did not have too much of a hard time, or most of it, in 2020. And let's talk about the S&P 500, the 500 largest companies in America. The return last year was 16.6% if you did not reinvest dividends. But the disparity that we talked about so many times throughout the year continued. The difference in style and sectors continued until the fourth quarter, when we had the vaccine, great news through Pfizer and Moderna that the vaccine was approved. And as I said, the disparity between the performances continued. So growth was actually up 35%, whereas pure value, even if you reinvested the dividends, was up about 2.6%. And inside, if you look at the S&P 500, the top 5 stocks were up a staggering 65%, with the bottom averaging 10%. How come? Well, energy was in there, the negative 34%, finance down 20%, and the disparity, again, between growth and value continued until the end of the year. Some other interesting statistics that happened last year was that volatility persisted. And not only did it persist, but it gave us some staggering statistics. So we had 109 days where the S&P moved more than 1%. That's 2 times the normal average of the last 10 years. And what's worse, what we had to endure, was that 2% moves in the S&P 500 occurred 3 times the long-term 10-year average. So volatility persisted, disparity between the sectors and the cap size and the strategies happened all the way until the end. Now, why the change at the end of the year was because of the vaccine. The positive rollout between Pfizer and Moderna allowed the cyclical space to finally see some relief and some outperformance to growth. So here at United, taking all of that into effect, we started to increase our exposure to the cyclical stocks, including industrials, materials, consumer discretionary, and we've remained with a large weight to technology, healthcare. So looking at all of this, why did the market recover so quickly? We're going to turn it over to Tom Healy, and he's going to talk to us about the fiscal response and how that played out.
Thanks, Lee. Going into 2020, the economy was on very solid footing. But as the virus began to spread and the economies went on lockdown, it caused a precipitous decline in economic activity. So Congress was compelled to replace a lot of what was lost, and that culminated in the $2 trillion CARES Act, which was passed in March of 2020. Basically, that consisted mostly of direct payment of $1,200 to individuals, but also backstopping small business loans, things like that. So that was a substantial payment. In fact, it was about 10% of GDP that was replaced through that act alone. But with the virus persisting as the year continued, we saw another $900 billion stimulus package passed in recent weeks, which is going to equate to about 4 to 5% of GDP in 2021. Again, featured a direct payment of $600. And where do we go from here? Because it's really important, because the economy remains shaky and the virus continues to persist. And as Lee mentioned, the vaccine has not been fully implemented as of yet. We see another stimulus package coming probably in February, consisting primarily of another direct payment, probably in the $1,400 range. So they get to that $2,000 that they were trying to get to back in December. It's also going to consist of vaccine funding, state and local funding, as well as unemployment benefit extensions. And so that's going to help get us through this period as well. And then we're going to finish the year. I think the administration is going to push very hard to get something in the order of a $2 trillion infrastructure package done. Now, the difference between that and the other previous stimuluses is that that's going to include a tax increase, mostly on the corporate side, but also individuals, in order to fund the infrastructure package. Now, even with a small majority in the House and a split majority in the Senate, it's going to take a lot more work to get this through Congress. So we do anticipate another stimulus in February, and then a major one as we get through the year, the timing and magnitude of which is really difficult to assess at this time. So that's where we stand, and that's why fiscal was so important, both to the economy but also to markets.
So I want to ask Matt DeLorenzo now regarding monetary policy and the Federal Reserve, which is always a very boost to the market or the opposite. What happened last year and how did it affect the markets?
Yeah, so last year, thanks Lee, last year when the markets were really in free fall in March, the Fed stepped in very aggressively and they announced a big package that was going to include additional agency mortgage purchases, treasury purchases, and even for the first time an intervention into the corporate bond market. And that was in addition to bringing Fed funds rate all the way down to zero. So that was really contributed to the bottoming process for the equity market and really stabilized and tightened credit spreads. And it really has brought yields all the way down to a very low level. So that reduction in corporate borrowing costs and consumer borrowing costs really helped stabilize the market, and the fact that they're anticipated to continue this way has really helped the market continue to run.
So when they reference the balance sheet, it grew.
It grew significantly, and they're actually on the pace of 120 billion a month, divided between treasuries and mortgages.
Has there been any indication of that they would stop anytime soon?
Actually, so far there hasn't been much, but the last couple days there have been some Fed speakers that are coming out and potentially starting to prep the market for a potential wind down of this towards the end of the year.
Okay. So as the monetary policy and the fiscal policy was very effective last year in helping that stock market recover and that recession be one of the shortest ones in history, I'd like to go back to Tom now and talk about corporate earnings as well as the macroeconomic landscape that we face today.
Sure, thanks Lee. As I mentioned earlier, we saw a precipitous drop in economic activity as the virus spread. To give some numbers to that, GDP declined by 31% in the second quarter, but it also rebounded significantly from a much lower base, up 33% in the third quarter. As we look into the fourth quarter, it's starting to stabilize more towards long-term trend line, still be a little higher at 4.5%. But as we look to 2021, we do anticipate GDP growth, although it's going to be lumpy based on the extreme comparisons from 2020. As that translates into earnings, we saw about a 15% decline in earnings in 2020. Now, we'll know that for sure in the next few weeks as the fourth quarter earnings period just started. But about a 15% decline is anticipated, much of that driven by, as Lee mentioned earlier, the economically sensitive sectors, energy, financials, industrials, materials. As we look to 2021, that's actually going to flip because the comparisons are so easy, and we'll see earnings growth in the area of 22% anticipated in 2021, driven by earnings from energy, financials, industrials, but also continued solid earnings growth from technology, communication services, so a much broader earnings growth. And then we look to 2022, and right now consensus has a 13% earnings growth as we get sort of the full reopening of the economy, we get the vaccine fully implemented, and we get to a more of a normal reopening of the economy. Again, the one headwind that we're going to have to assess is what will tax increases do to corporations really starting in 2022. Again, it's too early to really make that assessment because we don't know the size, the magnitude, and the timing of any such plan, but that's something we're going to be watching as we get into the end of this year. So that's kind of where we stand right now on the economy and also on corporate earnings.
Thank you very much. So Matt, you were just finishing up your comments regarding what was happening very recently. So could you please give us some comments about what you think you're seeing with the yield curve and as well as that nasty word inflation that seems to be on everyone's mind these days?
Sure. As far as the yield curve, what's happening right now is short-term rates are very low because the Fed has brought Fed fund rates all the way down to zero. And more recently, longer-term yields have been drifting higher. And that's really in response to increased expectations for inflation, a lot of extra treasury supply, and looking forward to an improving economy as the year progresses and the virus gets more in the rearview mirror. But as far as how that rolls into Fed policy, the Fed really has a dual mandate of trying to keep employment high and inflation low or at around 2%. And I feel that as we progress into this year, we're going to see some inflation prints that are higher than 2%, and that's going to cause the market to kind of question how accommodative the Fed can really be, and that to me can cause some bumps in the road for the markets, potentially widening in credit spreads, potentially higher yields, and those are things we would generally see as buying opportunities for our clients.
Okay, so I don't know that you're able to give us any comments about whether it would be runaway interest rates. Do you think the Fed would do anything to stop that from happening? Or would they be able to?
I think that they would be able to. They'd be able to do something, but I don't think it would be immediate. I think that they would let interest rates rise a little bit, but if it got to the point where it was becoming disruptive, corporate borrowing costs were going up too much, mortgage rates were going too high, that was really significantly slowing the economy, I think they would step in, potentially make some changes with their balance sheet, extend the maturities, or do something along those lines. But I do think in the meantime, if something like that happens where we have a spike in rates or a blowout in credit spreads, it would be a buying opportunity, being that we know that the Fed is really right there.
Great, thanks very much. So the combination of the effective Federal Reserve policies that have been put in place and fiscal response that's been huge is a tightrope that we're going to work with for the rest of the year at United Asset Strategies to modify the portfolios to take advantage of those parts of the industry that will be doing well and others that may not be recovering quite as quickly or responding well to the policies that come into play. So as we usually do at the end of our video is to talk a little bit about things that are happening here at United Asset Strategies. You all know that my title changed from president to chairperson of the board, and Mike Riccardi are now the majority owners of the firm. If you didn't know that, please call our office. We need to talk. But we also added to our incredible staff here at United Asset Strategies in the fourth quarter. We added Matt G. Verghese. He has 20 years experience and he's on our fixed income team. He brings a specialty in credit analysis that adds to the nice depth of our fixed income department. So in closing, I would like to say that we will be keeping our eyes on the new packages that the Congress passes as it relates to CARES Act or the equivalent, because we were able to help our clients last year take advantage of the different programs. And right now, if you happen to have one of those PPP loans and you're challenged about the timing of whether you should ask for forgiveness, whether there'll be tax on that, please call our office. You can ask for me, you can speak to Erin Gibbons. We'd be happy to talk to you about that. And again, as the programs roll out, we will stay on top of them and make sure that our portfolios reflect the best outcome for you. Thank you, everybody.